Hi, my name is Brad Cable, and I am President and a Private Wealth Manager with Bradley Cable Incorporated. I am also a financial advisor with LPL Financial, the largest independent broker-dealer in the country based on revenue. With these presentations, I hope to provide valuable information to people that seek strategies to navigating what has become a very complex financial environment. I encourage you to email or call if you have any questions on the topics presented. A quick contact form can be found in the Contact Us section of our website. Thank you for taking the time. What can we expect now? The markets and the economy. While strong crosscurrents remain in the financial markets, growing evidence points to an improving economic backdrop, healing credit environment, and emerging willingness of investors to take increased risk in their stock and bond investments. The economy remains fragile, yet robust fiscal and monetary policies have helped lead the way to an improved economic backdrop that continues to favor the unfolding of our base case forecast as initially presented at the end of last year. Economy. The economy may emerge from recession in the second half of 2009. We expect positive quarter-over-quarter readings on GDP in both the third and fourth quarters of 2009. Inflation. Inflation, which was not a concern during the first half of 2009, when deflation was the issue, appears poised to rise by the end of the year. Markets. Anticipate the year-end S&P 500 close to be around 1,000 to 1,050. After a wild ride, the stock market, as measured by the S&P 500, ended the first half of the year with a mid-single-digit gain that places the index about halfway back from the March low to our year-end return target. Fixed income. The bond market, as measured by the Barclays Aggregate Bond Index, will likely post a return in the mid to high single digits range. Expect less movement in Treasury yields in the second half that will help bring positive returns for the year. Alternative investments. Alternative volatility strategies performed well in the first half of the year, aided by the high volatility in both stocks and bonds. However, these strategies are likely to underperform opportunistic and long-only strategies as volatility subsides in the second half of 2009. Let's go back to a year ago for a moment. While GDP growth was below average in the first half of 2008, the economy was growing and credit markets were functioning. It was the failure of Lehman in September 2008 that triggered the crisis. The TED spread measures the difference between the 3-month LIBOR rate and the yield on 3-month Treasury bills. This is an effective measure of the liquidity available to banks. With the bank capital adequacy near the center of the current crisis, this is an important gauge of the stress in the banking system. The TED spread began 2008 about 1%, then doubled in March around the time Bear Stearns was bailed out, when J.P. Morgan absorbed it with the Fed guaranteeing against losses for a lot of the toxic assets. The crisis appeared to have been averted until the summer months, when the TED spread rose again, this time as Fannie and Freddie, the two entities that make up half of the home loans in America possible, were bailed out and effectively nationalized. Again, the rate came back down. Now, we all knew Lehman was next on the list to get bailed out. The expectation among investors, ourselves included, was that Barclays would absorb Lehman with the Fed guaranteeing against some of the losses. Similar deal as with Bear Stearns. In fact, this was so much a foregone conclusion that the stock market was up in the days leading up to the weekend the deal was to take place. But the political backlash was too great to bail out yet another firm, and the Fed denied Barclays the support it wanted, resulting in bankruptcy of Lehman on September 15th. The shock of a major player in the credit markets that was levered 40-1 resulted in this spike in rates. Banks wouldn't lend to each other for fear that the counterparty may go bankrupt. As a result, the whole financial system seized up. GE, a AAA-rated company, tried to borrow some money on a short-term basis in October, but there wasn't a bank in the U.S. willing to lend GE money. They had to go to Warren Buffett and pay 10% plus give up some equity. If banks weren't lending to GE, they weren't lending to smaller businesses or to consumers, and the economy crashed into the side of this mountain on the chart. The TED spread measures the liquidity, or oil, in the economic engine. You don't think about the oil until it is gone, and then the engine seizes up. The good news is that now we are starting to see signs that conditions have improved and growth is returning. You can see from this chart that the actions of the Fed and the Treasury have been successful in restoring liquidity to the financial system. Early this year, after publishing our outlook for 2009, we found that we needed a fact-based, objective way of tracking the conditions that drive the economy and markets. Conditions remain on a path toward our base case for 2009. The LPL Financial Current Conditions Index advanced to 0.8, the highest level since the index was created early this year after bottoming in early March 2008, along with the stock market. The index reflects current conditions aligned with our base case outlook for modest gains in the stock and bond market in 2009. Most of the 10 components of the index are in positive territory for the year. Measures of stress in the credit markets have shown the most improvement: BAA spreads in the corporate bond market and the TED spread for the lending among banks. The VIX, a key gauge of stress in the stock market, has also subsided notably since the start of the year. Deterioration can be measured in the first-time filings for unemployment benefits, initial jobless claims, and slumping demand for housing, mortgage applications. In general, the other components all have improved since the start of the year. Notably, shipping rates have risen as demand has picked up. This rise has also been seen in trucking and rail traffic. Also, despite little change in the low level of consumer confidence this year, retail sales have been trending mostly higher. Breaking down our outlook. Economy. The green shoots first appeared in consumer spending, which accounts for about 70% of GDP. The stabilization of consumer spending in the first half of the year occurred despite further deterioration in the labor market. Many of the fears of an uptick in inflation revolve around the economic and policy backdrop today that in some ways echoes the run-up to the high inflation environment of the 1970s and early 1980s. While some of these comparisons are valid, on balance, the economic and policy backdrop today is far less inflation-friendly than the economic and policy backdrop in the late 1960s and early 1970s that fostered the rise in inflation. Inflation remained low throughout most of the early to mid-1960s, but began to creep up during the next 10 years before exploding higher in the mid-1970s through early 1980s. Some attribute the rise in inflation to the heavy spending on the Vietnam War and President Lyndon Johnson's Great Society programs. We certainly can draw parallels to today, where government spending as a share of GDP has risen from 18.5% at the end of the 1990s to 21% in 2008, the highest since the early 1990s. Hoarding the cash. Missing here is what is actually happening to the money being created by the Fed's actions. In order for additional money supply to cause inflation, it must be put into use in the economy. For the most part, the money is not making its way into the economy and is therefore not likely to cause inflation. The reason these money multipliers are collapsing and money is not making its way into the system is simply that banks are hoarding the cash that is being created rather than lending it out. For example, the money multiplier, the ratio of the money supply to the monetary base, has contracted sharply over the past few months. Thus, the data suggests that the quantitative easing program the Fed and other central banks are engaging in is merely offsetting the deflationary impact of contracting credit availability. It is filling the void that was created when the financial system nearly collapsed and the expansion of private capital ground to a halt last fall. Also note that the quantitative easing in the United States was not led to any pickup in long-term inflation expectations measured by surveys or markets. Breaking down our outlook. Bond market. Bond performance varied a great deal between government bonds and non-government assets. It's been a dramatic reversal from what we saw in 2008. Credit-sensitive bonds such as corporate and high-yield bonds outperformed treasuries by a wide margin throughout the first half of 2009. Improving liquidity and less worse economic data helped restore some normalcy to credit markets. Emerging market debt also benefited from a strong policy response. The G20 group of finance ministers and central bank governors agreed to triple the resources of the International Monetary Fund to $750 billion and included a line of credit for EMD issuers. The added resources greatly reduced liquidity risk. Despite the dramatic rebound, we think non-government sectors still have room for improvement.